A few things that we talked about last night. I've cleaned up this spreadsheet a little bit from my examples. It'll be a little easier for you to follow. So we're just going to walk through week 2 homework examples. The first one was a net present cost, not a net present value, a net present cost. This example has all the cash going out. So we're buying something, a piece of equipment. The example I think was a bus. And the money, we're going to put some money down, and then we've got maintenance on it and so on. I've changed the numbers around here so it shouldn't match any problem you've had before. We have a rate that was given to us at 10%. We have an initial cost of $5,000. In this case, we have outgo of $1,700, $1,500, $1,500, and $1,400 over the next 4 years. We have now taken those 4 years and discounted them back to get their present value. We did net present value of C5, which is the 10% and the rate, and then we windowed in the values. So if I hit escape here, you can see that the formula up here is C5, comma, D7 to G7. That's these cells here. So this is the discounted future cost. We've discounted it back at 10%. Another way to say that is, if I deposited $4,868 today, I could withdraw $1,700, $1,500, $1,500, and $1,400 to end up with zero. So this is the cost it is today if we were making 10% on our money. So you've got the initial cost of $5,000, that's in today's dollars, and this is the present value in today's dollars of all this future cash flow, what it would be worth to you today. So what this one particular project A here costs total is $9,868. $5,000 today, and then the value you would have to put in the bank today, $4,868, to be able to pay all these future bills. So the value of this bus, the cost of this bus is $9,868. Now we compare to another project here. We go to another project, and the bus B is $4,500 out front, and then it's $1,500, $1,500, $1,400, and $1,300. We discount those back, and you can see that the formula appears net present value with the discounted cash flows back. And we get 4,500 plus 4,543 equals 9,043. So now we have project A at 98 and project B at 9,000. And so we look at this and we say, well, we should always choose the lower of the net present cost if all else is equal. Well, the way I put this into words, and you can put it in the words that come to you, but what I'm really saying is, in this example, project B has a lower net present cost. The difference isn't so large that it would take much of a non-financial advantage in A to choose it over B, or consider them at least equal. In other words, if I'm going to spend $9,800 on one and $9,000 on the other, the $800 difference to me here, this is a judgment call, isn't so significant that I wouldn't be looking at, does project A, whatever project A is, in this case a bus, have some advantages that project B doesn't have. It could be reputation, it could be better color selection, it could be almost anything. But is that worth $800 difference, or do you consider these equal and you look at other things? Now remember, we have to do the math because the math tells us whether the two projects are wildly different. But once the math comes out, and if they're fairly close, other factors can influence our decision. So in this case, I think $800 on a $9,000 item is fairly close. I would tend to want to save the $800, but not guaranteed. That's net present cost. Now let's go to net present value. Net present value is a different example. We have project A and project B again. The rate here I've changed to 8%, no big deal. This has two different directions of money. The money going out up front is the cost of the project. We're spending, in this case, $5,000 for the project. In the future, we're going to receive $1,700, $1,500, $1,500, and $1,400 cash inflow. So this is cash out, and this is cash in. That's a difference from this example where all of this is cashed out. All we're doing here is figuring out what the net present cost is. In this case, we're looking for the net present value. If we invest $5,000, how much do we get back? So in this case, we use net present value, but we add the additional term at the end. C20 is an additional term. That additional term is the value of the project, or not the value, the cost of the project going out at the beginning. Now, in this case, what you should do, I added this as an additional number from the cash flow calculation we did previously, and I added it as a positive, but I showed it here as a negative. So adding it as a positive, because the cell is negative, will actually subtract it. So if you end up with a net present value of 79.87, which is a positive number, so this project would be a positive project and make us money. We would be making money. If we deposited $5,000 and we wanted our 8% return, we would beat that 8% return by $79.87. The other calculation we can do is an internal rate of return. The internal rate of return, this error message simply says it omits adjacent cells. In other words, I didn't put the cells next to each other. That's no big deal. We just get rid of that and don't worry about it. The IRR shows you that IRR is simply the values. So I put the negative 5,000 here. That's very important that the computer, the calculations know this is a negative number. And then all these are positive numbers, cash flows coming in. So it's simply IRR and then window these in parentheses. So we have an IRR of 8.73%. In other words, if net present value was 0 and we earned exactly 8%, or we weren't going to earn 8%, we were going to earn a little bit more than 8%. If NPV was 0, we would earn 8.739% on our return. We would deposit 5,000 or invest 5,000. The discounted cash flow of these future years is discounted back, and if we discounted it back at 8.73%, we would get a net present value of $79. So let's just go ahead and do that. We'll put this in at 0.0873, enter, and you can see that net present value basically 0. I didn't extend it all the way out in the decimal, but you can basically see that the decimal, or the IRR makes net present value equal to 0. So it's nothing above this rate of return. This is the rate of return you're going to get. So if I turn that back to 0.08 and I go back to 8%, it's $79. Now we can compare this to another project, because this project, even though this is a positive return, we know how much the return would be, but we might have limited capital. In other words, we don't have $5,000 for every project. We only have $5,000 for one project, or close to it. So we'll compare to this other project. This one costs $4,500 and it brings in just a little bit less cash flow. So we do the same calculations, but because we're putting in less money and we're generating pretty good cash flow from it, the net present value here is significantly higher, $241. We are having a higher return than 8% by a good margin. That's also shown in our IRR. This cash flow generates an income of 10.45%. Well, that's pretty good compared to 8.73. So in this case, we would choose higher NPV or IRR if all else is equal. And in this example, Project B has a higher NPV and a higher IRR. So it's clear choice. We would pick Project B here. And this difference is pretty big. You know, the difference between $79 over the investment, or $241, well, that's like 3 times as large, or pretty close to 3 times as large. And so that's a pretty good difference. So I would need a good reason to not select Project B. I wouldn't say it's fairly close. I would say Project B is a clear winner. So these are judgment calls for sure, and you're always going to make a different judgment call. And Project A may have something. It's going to make you money. At 8%, it's going to make you money. However, Project A may have other factors. It may be easier to do and so on. So this is one of the things you would choose and write up in your analysis. The final example is valuation. So valuation, we talked about this on how to value a company, and the valuation of a company is very straightforward, except you have to project the future cash flows. That is the tricky thing, and that's in your corporate finance or your investments class. We're not going to get into that here, but I've just given you some examples here of future cash flows. We're going to discount this back at 8%. That's the level of risk we feel the company's at in this example. And this valuation is simply the net present value of this discount factor and these cash flows. When we figure out that net present value, that is the total valuation of the firm. Now, having said that, there's not one share, or there's not just one share of the firm. This firm is divided by 100 different shares. So there's 100 different shareholders with one share each, and each value of the share is $4.29. So we would simply look at this into the market price, and we look at the market price and say, is the market price higher or lower than what we think it should be? If the market price was 10 and we thought it was worth $4.29, we clearly wouldn't buy it. In fact, we would either sell it or short it maybe. If the market price was 2 and we felt that it was $4.29 valuation, we might want to buy it. We would see value there. To put it in words, if the future cash flows are as shown and the correct discount rate for this level of risk is also shown, in other words, the 8%, that's correct, then the value of the company is shown in total, then divided by the number of shares to get the value of one share of stock, and then just simply compare that to the market price to make a decision. I also said you could do this backwards. Now this is doing it backwards. The cash flows are the same. We've predicted those cash flows through our analysis, and as I said, that's in a different class. These are just going to take them as given. And then in this case, we look at the market price, and the market price is $5 a share. Now if it's $5 a share and there's 100 shares, we simply multiply these two numbers to get our total value of the company, and the total value is $500. Well, if the shares are $500, the company costs $500, we make that a negative cash flow because we assume we bought the whole company for $500. And then what do we get in return for that purchase? We get all these cash flows. Well, if we paid $500 for this company and we get these cash flows, what is the internal rate of return on that? In this case, we just do an IRR on these cells, and we will get the return on this investment. The return on this investment is 2.78%. We don't like 2.78%. That's too low. So this $5 price is too high. So if the market price wasn't $5, say the market price was $3, we would see that the internal rate of return was 22%, and we would only be paying $300 for the company to generate these cash flows. So you can see that the price you pay for the stock is very, very important. It sets how much return you'll get. The lower the price you pay, the more return you're likely to get. So if we look at this in conjunction with the previous problem, we figured that our determination, our valuation was, if we think that the company should return 8%, then we value the company at $4.29. If we think the company should return 10%, we would value the company at $4.06. If we believe that this company should return, it's very safe, it's like PG&E, it's almost like a savings account, maybe should only return 4%, we turn in 4%, and the company's worth $4.82. So you can see, or the shares are worth $4.82. So you can see that your $3, $4, $5 price is going to modify the rate of return on the company, and our original valuation is based on what we think that return should be. In this case, we originally assumed the return would be 8%, and that will give us a $4.29 price. So if the market price was actually $4.29, you could see that the internal rate of return would be very, very close with round-off error to 8%. But by going backwards, we can just look at the market price and say the market price is $5, therefore the return on this company will be $2.78. I think that price is too high, so we're going to wait for the market price to come down to $3. Now I'm making 22% on the company, given the same exact future expectation of cash flow. And so given that, I would buy the company at $3. I would not buy it at $5. And that's how you'd make a valuation decision using market price on a company. Now, this last problem I'm giving you just to show you how the way the stock market works and the world works. I'm not going to put this into an exam for you. This is actually in the corporate finance program, the MBA program. But you should be, it's nice to know this. A lot of you are going to have 401ks, or almost everyone is going to have a 401k or own stock at some point. And so this is really exactly what Wall Street does. It just does it in a more elaborate way with much more analysis on where these numbers came from. But the math is the same. So to put this in words, if the future cash flows are shown and the market price of the stock is known, then multiply the share price by the number of shares to find firm value. So $3 times 100 is $300. Then multiply the, and then use it as a negative cash flow out. In other words, I paid $300 for the firm, and offsetting that is the future cash flow in to generate your IRR. So in this case, the IRR is cells from D to H on row 42, or excuse me, C to H on row 42, C42 to H42, and so it's all of these cells here. So I just windowed all these in and turned it into an IRR. The $300 is how much I paid for the entire company, and what did I get in return? I got the ability to have 95, 95, 105, 120, and 130 come into me. So that'll give you an example of all three problem types. So net cost is all cash going out. It's the cost of, say, a bus system or a piece of equipment or other things. The net present value is an investment. You put out your $5,000 and you return coming into you 17, 15, 15, and 14. And then the valuation example is what is this cash flow worth at a certain discount rate? And that in this case shows $4.29 because we assumed the 8% is a fair rate of return for this kind of company. In another way to look at it is the market's paying $3 for this stock. The $3 share times 100 shares is $300. The $300 for the valuation of the company is if we spent $300 to buy every share and own the whole company, what would we get back? We'd get 95, 95, 105, 120, 130. What is this rate of return given this initial investment? 22.26%. If it was actually $5 that we put out, or $500 for the whole company, would only be earning 2.78%. So there's three different examples and three different uses. The net present value, net present cost calculations are how you get the numbers for a decision. In the first case, the numbers were pretty close, 9868 versus 9,000. Not really sure if that would be a deciding factor. In the second case, it was 79.87 versus 241. This makes B a very heavy favorite. You'd have to come up with something good to not choose B. It gives you almost a 2% higher return. So B would be a much clearer winner than the first problem. And then the last problem, the valuation. We feel the stock is worth $4.29. If the market's valuing it at $5, we certainly wouldn't take the 2% return. If the market's valuing it at $3, we would love the 22% return. So how far off you are from what we think fair value is would tell you whether you buy or sell. So there's a few examples there of the homework this week. I will give you this spreadsheet next week after you turn in your homework. So what I would like you to do is try to create this spreadsheet. You've got the net present value calculations and so on, but I want you to recreate this. I will eventually give you one so you know it's right and it works. But instead of giving you this where you just plug in different numbers and it automatically works, I'd like you to try to create your own so you get experience doing that. That's why I'm not sending you this, I'm doing a video. I will give you one eventually like I did with the time value of money, but in this case, I'm going to let you design your own and come up with this. So, any questions, you know how to get hold of me. Thank you so much for listening. You're an awesome class. I will see you in class.